There's a pattern in history that has destroyed every global reserve currency, not most of them. Every single one. The Portuguese Real dominated global trade for 80 years, then collapsed. The Dutch Guilder ruled for 80 years, then fell. The British Pound reigned for 105 years, then died. Each followed the same 7 stages. Each believed they were different. Each thought their currency was permanent, and each was wrong. The US dollar became the world's reserve currency in 1944. That was 81 years ago, and right now in 2025, the dollar is in stage 5 of that same 7-stage pattern. This isn't prophecy, this is mathematics, a sequence that has played out 4 times across 6 centuries. And the only question that matters is this: are we smart enough to see what's coming, or arrogant enough to believe this time is different? Let me show you the pattern, the 7 stages every reserve currency goes through, and exactly where the dollar sits right now. But before we go through the stages, you need to understand what a reserve currency actually is. It's not just a strong currency, it's the currency other nations hold in their central bank reserves, the currency used to price global commodities. The currency international trade is denominated in. When you are the reserve currency, every country needs your money. To buy oil, they need your currency. To settle trade imbalances, they need your currency. To hold safe assets, they need your bonds. This creates something called exorbitant privilege. You can print money and export it to buy real goods. Other countries have to produce goods to earn your currency. You can run endless trade deficits because foreign nations need to accumulate your currency for reserves. You can borrow at lower interest rates because global demand for your bonds is structural, not discretionary. Being the reserve currency is the ultimate economic weapon. It's why empires fight to achieve it and why they begin to collapse when they lose it. Now, here are the 7 stages, and as we go through them, you'll see exactly where we are. Stage 1, military dominance and control of trade routes. Every reserve currency begins the same way, with overwhelming military power that controls critical trade routes. Not just having a strong military, controlling the pathways global commerce flows through. In the 1450s, Portugal achieved something unprecedented. They mastered oceanic navigation. While other European nations were still hugging coastlines, Portuguese sailors were crossing open oceans. They rounded the Cape of Good Hope in 1488. This opened a sea route to Asia that bypassed the Ottoman-controlled land routes. And they militarized that advantage. Portuguese warships dominated the Indian Ocean, the South China Sea, and the Atlantic. They established fortified trading posts at strategic choke points: Goa, Malacca, Macau, Mozambique. These weren't just ports, they were armed fortresses. Portuguese cannons controlled who could trade, and on what terms. If you wanted spices from the Moluccas, you dealt with Portugal. If you wanted to trade with India, you needed Portuguese permission. They charged fees, they imposed tariffs, and they seized ships that tried to bypass their system. This military control of trade routes made the Portuguese real the currency that mattered. Merchants across Europe, Africa, and Asia needed reals to conduct trade in Portuguese-controlled waters. It became the currency of international commerce. Not because it was backed by gold, not because it was economically superior, but because it was backed by cannons. The Dutch followed the same pattern in the 1600s. The Dutch East India Company wasn't just a trading company, it was a military power. It had its own army, its own navy. At its peak, the VOC had 40 warships and 20,000 soldiers. They conquered Portuguese trading posts, they seized control of the Spice Islands, they established Amsterdam as the center of global trade. Dutch ships dominated the Baltic, the Atlantic, and the Indian Ocean. If you wanted to trade, you needed guilders, the currency of the power that controlled the seas. Britain in the 1800s perfected this model. At its peak, the Royal Navy had more warships than the next 5 nations combined. Britannia rules the waves wasn't poetry, it was fact. The British controlled the Suez Canal, Gibraltar, Singapore, the Straits of Malacca. Every critical choke point in global trade was under British control. The pound sterling became the global currency because British naval power made it nearly impossible to conduct international trade without it. The United States achieved the same position after World War II, not just by having a strong military, but by controlling global trade infrastructure. The US Navy dominates every ocean, 11 aircraft carrier battle groups, more than the rest of the world combined. The United States controls or maintains bases near every critical trade choke point: Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. This isn't just about defending America, it's about controlling global commerce, making it nearly impossible for international trade to function without American approval. That's stage 1, military dominance over trade routes. The dollar achieved this in 1945, and it maintains it today. Check. Stage 2, massive trade surpluses, the accumulation of global wealth. Once you control trade routes, you begin accumulating wealth from the rest of the world. Not through theft, through advantageous exchange. Portugal in the 1500s ran massive trade surpluses. They bought spices, silk, and porcelain from Asia using gold and silver. But they sold European goods, textiles, weapons, and African slaves at enormous markups. The balance of trade flowed toward Lisbon. Portuguese ships returned heavy with Asian goods that sold for 10 times what they paid. This surplus turned Lisbon into one of the wealthiest cities in Europe. The Portuguese crown's revenues from trade were so large that they funded the entire government without heavily taxing the domestic population. The Dutch in the 1600s did this even more systematically. Amsterdam became the warehouse of the world. Goods from Asia, the Americas, and Africa flowed through Amsterdam. The Dutch bought low in one market, sold high in another, and captured the spread. They weren't just traders, they were global-scale arbitrageurs. The Dutch trade surplus was so enormous that Amsterdam overflowed with wealth. Canals lined with mansions, merchants richer than many European kings. Britain in the 1800s ran the largest trade surplus in history up to that point. They exported manufactured goods, textiles, steel, machinery, ships to the world. They imported raw materials, cotton, tea, rubber, at prices set by British buyers. The terms of trade were dictated by London. The surplus transformed Britain into the wealthiest nation on earth. London's financial district handled more capital than the rest of Europe combined. The United States experienced the most dramatic trade surplus in history from 1945 to 1970. After World War II, America was the only major industrial power with intact infrastructure. Europe and Asia were rebuilding. The US exported machinery, automobiles, steel, and consumer goods to the world. The surplus was so large that dollars flooded into foreign central banks faster than they could be recycled. US gold reserves swelled. By the 1950s, Fort Knox held over 20,000 tons of gold, more than the rest of the world combined. This is stage 2, massive trade surpluses, the accumulation of global wealth through advantageous exchange. The dollar achieved this from 1945 to 1970. But this is where the pattern begins to shift, because stage 2 doesn't last forever. Eventually, the reserve currency nation moves from producing goods to consuming them, from exporting to importing, from running surpluses to running deficits, and that's when stage 3 begins. Stage 3, reserve currency status formalized, the tipping point. At some point, the world formalizes what is already true. They officially adopt your currency as the reserve. This is the peak, the moment of maximum power. For Portugal, this happened in the early 1500s. European nations and Asian merchants officially recognized the real as the primary currency for international transactions. Treaties were written denominating trade in reals. It became the standard. For the Dutch, it happened in the mid-1600s. The guilder became the currency of choice for international contracts. Bills of exchange were written in guilders. Even the British East India Company used guilders in some transactions because Amsterdam's financial markets were the most liquid in the world. For Britain, it happened at the Congress of Vienna in 1815 after the Napoleonic Wars. The pound sterling was explicitly recognized as the global standard. International treaties, loans, and trade contracts were denominated in pounds. The gold standard, adopted by most nations, was effectively a pound standard because Britain controlled the rules. For the United States, it happened at Bretton Woods in 1944. 44 nations met in New Hampshire and formally agreed to make the dollar the world's reserve currency. Other currencies would peg to the dollar. The dollar would peg to gold at $35 per ounce. The International Monetary Fund and the World Bank were created to manage this system. It was the most explicit formalization of reserve status in history. But here's what nobody tells you about stage 3. This is the peak. This is as good as it gets. Because formalizing reserve status plants the seeds of its own destruction. Once you are the reserve currency, the world needs your currency more than they need your goods. So you stop producing goods, you start importing, the trade surplus reverses into a deficit, and the deficit becomes permanent. This is called the Triffin dilemma, named after economist Robert Triffin, who explained it in 1960. For the world to have enough dollars for reserves and trade, the United States must run trade deficits, the US must send dollars abroad, but running endless deficits undermines the value of the currency. You cannot be both the world's reserve currency and maintain a strong trade balance. It is mathematically impossible. So every reserve currency, once it reaches stage 3, begins the slide towards stage 4. Stage 4, deficit spending and living beyond means. The reversal? This is where the pattern becomes irreversible. The reserve currency nation stops producing wealth and starts consuming it. Portugal saw this in the mid-1500s. The trade surplus disappeared. Instead of exporting goods, Portugal began importing everything: grain from Sicily, textiles from Flanders, manufactured goods from across Europe. They paid for all of this with gold and silver from Brazil and Africa, but they weren't producing wealth anymore. They were spending wealth accumulated in earlier decades. The Portuguese crown's spending exploded. King João III spent lavishly on palaces, churches, and the royal court. Military expenses to maintain the empire drained resources. And here's the key: they didn't notice the problem, because the money kept flowing. As long as Brazilian gold kept arriving, they could keep spending. But the gold wasn't infinite, and they weren't building productive capacity with it. They were consuming. The Dutch in the 1700s followed the same trajectory. After a century of trade surpluses, they became net importers. Amsterdam's wealth made its citizens comfortable. Why work in factories when you can live off accumulated capital? Dutch investment shifted from trade and production to finance. They became bankers to Europe. They lent money instead of producing goods. This generates returns, but it's passive income, not productive growth. The trade balance reversed. They were importing more than they exported. They paid for it by liquidating accumulated wealth. Britain in the early 1900s faced the same reversal. By 1900, Britain was running trade deficits. They imported food, raw materials, and increasingly manufactured goods. They paid for this with returns on overseas investments, centuries of accumulated wealth, invested in railroads, mines, and enterprises across the empire. The investment income was enormous, but it was extracting wealth created elsewhere, not creating new wealth at home. British manufacturing declined. Factories that had led the Industrial Revolution were closing or falling behind American and German competitors. The trade deficit grew every year, living beyond their means, financed by liquidating the past. The United States entered Stage 4 in 1971. That's when the trade surplus permanently reversed into a deficit. By the 1980s, the deficit was growing rapidly. By the 2000s, the US was running the largest trade deficit in history, around $800 billion annually. America imports far more than it exports: consumer goods, electronics, automobiles, textiles, everything from abroad. How is this financed? By exporting dollars, printing currency, exchanging paper for real goods. This only works because the dollar is the reserve currency. Other nations need dollars for reserves and trade, so they accept them. But this is living beyond your means, consuming more than you produce, and it's the same pattern that preceded the collapse of every previous reserve currency. Stage 5, currency debasement and money printing, the desperate measure. When deficits become unsustainable, when you can't borrow enough to finance spending, you debase the currency, you print. Portugal did this in the 1550s. Facing deficits and declining trade revenues, the Portuguese crown began debasing the real. They reduced the silver content in coins. They issued more currency than they had metal to back it. Inflation followed, prices rose, merchants began refusing reals or demanding more of them for goods. Purchasing power eroded. By the 1570s, the real was losing credibility. International merchants began preferring other currencies. The Dutch did the same in the 1700s. The guilder had once been backed by strong banking and conservative policy, but by the mid-17th century, the Dutch government was borrowing heavily to finance wars and maintain the empire. When borrowing became too expensive, they inflated the currency. Printed money to cover deficits, the guilder's value declined. By the 1780s, it was no longer the preferred currency for international trade. Britain debased the pound through 2 world wars. World War I forced Britain to print money and temporarily abandon the gold standard. They returned to gold in 1925, but at an overvalued rate, causing economic pain. World War II forced them off gold permanently. By 1945, the pound was floating and losing value. Britain printed money to rebuild and fund the welfare state. The pound was devalued repeatedly, and in 1949 and 1967, each devaluation eroded international confidence. By the 1970s, the pound was no longer a reserve currency, it had become regional. The United States entered Stage 5 in 2008. The financial crisis forced the Federal Reserve to print money on a scale never seen before. Quantitative easing, $3.5 trillion, created between 2008 and 2014. Then COVID hit, another $7 trillion, printed between 2020 and 2022. The money supply expanded faster than at any time in American history outside wartime. This is currency debasement, not by reducing metal in coins, but by expanding fiat supply. And the effect is the same. Purchasing power declines, inflation surges. In 2021 and 2022, inflation reached levels not seen in 40 years. The difference between the US and previous reserve currencies is scale. The dollar is global. When the Federal Reserve prints, it exports inflation to the entire world. Other nations watch their dollar reserves lose value. Their dollar-denominated debt becomes cheaper to repay, but their imports from America become more expensive. This is where confidence begins to crack. And once confidence breaks, stage 6 follows quickly. Stage 6, loss of confidence and the search for alternatives, the breaking point. This is when the world starts looking for exits. Trust erodes. Nations begin shifting reserves into alternatives. Portugal lost confidence in the 1570s and 1580s. International merchants began demanding payment in Spanish silver or Venetian ducats instead of Portuguese reals. Trade contracts were written in other currencies. Asian merchants who had accepted reals for decades began refusing them, or demanding larger quantities to compensate for debasement. By 1580, when Spain annexed Portugal, the real was already functionally dead as a reserve currency. The annexation only formalized what markets had already decided. The Dutch guilder lost confidence throughout the 1700s. France, Britain, and other European powers began shifting reserves elsewhere. By the 1780s, Amsterdam was no longer Europe's financial center. London had taken that role. The guilder still circulated regionally, but it was no longer dominant in major international trade. The shift was gradual, but irreversible. The British pound lost confidence rapidly after World War II. In 1945, Britain owed massive war debts to the United States and its allies. The pound was overvalued, propped up by American loans. In 1949, Britain devalued the pound by 30%. International holders of pounds lost nearly 1/3 of their value overnight. Confidence collapsed, nations began shifting reserves into dollars. By 1960, the pound's share of global reserves had fallen from over 60% in 1945 to less than 20%. Within 15 years, the transition from pound to dollar was complete. Now look at today. The US dollar is in the early stages of stage 6. The signs are everywhere. China and Russia began reducing dollar reserves in the 2010s. They started buying gold, thousands of tons. China's official gold reserves have more than doubled since 2008. Analysts believe unofficial holdings are far larger. Russia liquidated nearly all of its US Treasury holdings after the 2014 sanctions. The BRICS nations, Brazil, Russia, India, China, South Africa, have openly discussed alternatives to the dollar for trade. In 2023, they announced plans for a BRICS currency. It hasn't launched yet, but the fact that it's being discussed matters. Saudi Arabia, which priced oil exclusively in dollars since 1974, forming the foundation of the petrodollar system, began accepting yuan for oil sales to China in 2023. That breaks a 50-year precedent. Central banks globally are diversifying. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2024. 14 percentage points. It sounds small, but that represents trillions of dollars moving out of dollar assets. The euro, yuan, and gold have absorbed most of that shift. Even smaller nations, Thailand, Malaysia, Indonesia, are negotiating trade agreements settled in local currencies instead of dollars. This is the beginning of stage 6, the world searching for alternatives. Not because they hate America, but because they recognize the pattern: endless deficits, currency debasement, loss of purchasing power. They aren't waiting for stage 7, they are positioning now. Stage 7, replacement and collapse, the end. This is when a new currency rises, not through a grand ceremony, not through a formal vote, but through market adoption. The world simply stops using the old currency and starts using the new one. The Portuguese real was replaced by the Spanish silver peso in the late 1500s. Spain had conquered massive silver mines in the Americas, Potosi in Bolivia, Zacatecas in Mexico. These mines produced more silver than the rest of the world combined. Spanish silver coins became the preferred global currency. They were abundant, standardized, backed by ongoing production. The debased real couldn't compete. Merchants rejected it. The transition took about 2 decades. By 1600, the real was irrelevant. The Dutch guilder was replaced by the British pound in the late 1700s and early 1800s. Britain's industrial revolution and naval dominance made the pound the natural successor. London's financial markets became deeper and more liquid than Amsterdam's. The pound was backed by manufacturing power and global trade strength. The transition took roughly 30 years. By 1815, after the Napoleonic Wars, the pound was the undisputed global standard. The guilder had become regional. The British pound was replaced by the US dollar between 1945 and 1960. The transition was formalized at Bretton Woods, but took years to fully unfold. Britain was bankrupt after World War II. The United States held most of the world's gold and possessed the only intact industrial base. The dollar was the only currency capable of serving as a global standard. The pound declined through repeated devaluations, and the world moved on. By 1967, when the pound was devalued again, it was clear the dollar had fully replaced it. So, what replaces the dollar? That's the question everyone's asking. And the answer isn't clear, because we're not at stage 7 yet. We're in stage 6, the search for alternatives. But history gives us clues. The replacement currency comes from a nation with military dominance over trade routes, a trade surplus, strong productive capacity. Right now, that isn't any single nation. China has the trade surplus and production, but it doesn't control global trade routes militarily. The yuan isn't freely convertible. Capital controls prevent it from being a true reserve currency. You can't be the world's reserve currency if money can't move freely in and out of your country. The euro is the second most held reserve currency, but Europe faces deep structural problems, aging population, no unified fiscal policy, dependence on external energy. Germany has production, Southern Europe doesn't. It's a fragmented system. Gold is growing in appeal. Central banks are buying more gold than at any time since the 1970s. Gold can't be printed, it can't be debased, but it can't scale to handle trillions in daily transactions. There's simply not enough gold in the world to back the volume of global trade. Some analysts think the replacement won't be a single currency, maybe a basket, IMF special drawing rights, a mix of currencies, becomes the standard, or maybe technology enables something new, a digital currency backed by a commodity or algorithm. Bitcoin maximalists believe crypto will replace fiat, but governments won't voluntarily surrender monetary control to a decentralized system. The most likely scenario, a messy transition, a period of multipolar currency competition. Several regional currencies used in different trade blocs, the dollar in the Americas, the euro in Europe, the yuan in Asia, gold for settlement between blocs. It won't be clean, it will be volatile, unstable, economically painful, but that's how transitions happen when there's no clear successor. Now, why does this matter to you? Why understanding this pattern isn't academic, it's survival. When reserve currencies collapse, it doesn't just affect governments, it destroys ordinary people's savings and wealth. Portugal's collapse in the late 1500s caused depression across its empire. Merchants holding reals saw their wealth evaporate. The Dutch collapse in the 1700s devastated Amsterdam's middle class. Savings held in guilders lost value. Investments denominated in guilders became worthless. Britain's collapse after World War II impoverished a generation. Citizens holding pounds in bonds, pensions, or cash lost purchasing power repeatedly. The American collapse, it's happening in slow motion. Every dollar you hold is losing purchasing power. Since 2020, the dollar has lost roughly 25% of its value through inflation. Your savings, your paycheck, your retirement account, if denominated in dollars, buys 25% less today. And this is just the beginning of stage 6. If the pattern holds, if the dollar follows the same trajectory as every previous reserve currency, the next decade could bring accelerating decline, more inflation, further loss of purchasing power, more nations dumping dollars. And when stage 7 arrives, the replacement, there will be a moment of collapse, a currency crisis. The dollar could lose 50% of its value in months. This happened to the pound in 1949. It can happen to the dollar. So what should you do? First, understand this. Holding dollars is a risk, not a safe haven. The dollar is slowly losing reserve status, and it's accelerating. Diversify. Don't hold all your wealth in dollars. That doesn't mean abandoning dollars entirely. You need dollars to live if you're in the US, but don't rely on them as the foundation of your wealth. Hold assets that preserve value across currencies, real estate, productive businesses, commodities. These maintain value no matter what happens to the dollar. Second, watch the indicators of stage 6, central bank reserve data. Accelerating declines in dollar reserves confirm the transition is speeding up. Trade agreements. If major nations start settling trade in other currencies, that's a clear signal. Gold prices. If gold surges, it means the world is fleeing fiat currencies. Third, understand this isn't politics. It's not about liking or disliking American policy. It's mathematics. The same mathematics that destroyed the Portuguese real, the Dutch guilder, and the British pound. Every reserve currency follows the same 7 stages. The dollar's in stage 5, moving into stage 6. The pattern doesn't care about exceptionalism, it doesn't care about military power or economic size. It cares about deficits, debt, and debasement. And on those metrics, the US is following the script perfectly. Here's what should terrify you: the timeline. Portuguese real, 80 years, 1450 to 1530. Dutch guilder, 80 years, 1640 to 1720. British pound, 105 years, 1815 to 1920. Each lasted roughly 80 to 110 years. The US dollar achieved reserve status in 1944, 81 years ago. We're at the average lifespan. We're showing every symptom of late-stage decline, massive deficits, currency debasement, loss of confidence, search for alternatives. Stage 7, replacement. But here's what's different this time, genuinely different. Every previous collapse was regional. The real affected Portugal and its partners. The guilder affected Amsterdam and Northern Europe. The pound affected Britain and the Commonwealth. But when the dollar collapses, it's global. It's embedded in every economy, every central bank, every trade transaction, every commodity price, oil, gold, wheat, all priced in dollars. There's no part of the global economy that won't be affected. This means the transition will be chaotic. There's no clear replacement ready. The scale of dollar-denominated debt, over $70 trillion in bonds alone, means a collapse triggers defaults across every continent. Emerging markets borrowing in dollars won't be able to repay corporations with dollar bonds face bankruptcy. Even developed nations holding dollar reserves see central bank balance sheets implode. The systemic risk is orders of magnitude larger than 1949 or 1780. This isn't just a currency transition, it's a restructuring of the global financial system. And restructurings are never smooth. They're painful, chaotic, and destructive to existing wealth. Let me be clear. I'm not saying the dollar collapses tomorrow. I'm not saying the US becomes a failed state. I'm not saying panic and sell everything. What I am saying, the pattern exists. 7 stages, 4 historical examples. The dollar is in stage 5, entering stage 6. The timeline suggests 10 to 20 years before stage 7, maybe less if the transition accelerates, maybe more if the US somehow breaks the pattern. But breaking the pattern requires something no previous reserve currency managed: reversing deficits, stopping money printing, rebuilding productive capacity. These aren't just policy choices, they're politically almost impossible. Democracies vote for comfort, stimulus, and printing money, not short-term pain for long-term stability. The pattern continues. Stage 6 accelerates into stage 7. The people who understand this position themselves accordingly. They diversify out of pure dollar assets, they hold real assets. They watch the indicators. When stage 7 arrives, they aren't caught holding a collapsing currency. They hold assets that maintain value across currencies, exactly what Portuguese merchants, Dutch bankers, and British elites did in the past. The reserve currency death pattern isn't a conspiracy, it's a historical cycle documented across 6 centuries, 7 stages, and now a 5th currency. The only question, will you see it before it completes, or will you be the liquidity that transfers wealth to those who did? The pattern is clear, the timeline is evident, the dollar is in stage 5. Stage 6 and 7 follow, not as possibilities, but as probabilities bordering on certainty. This is how reserve currencies die, not with invasion or catastrophe, with mathematics. Slow, then fast, ignored, then undeniable. By the time everyone sees it, the transition is complete. 4 times it played out, 80 to 110 years, 7 stages, and it's happening again right now. Subscribe to track stage 6 as it unfolds.